We are live for a RTD Q&A. Excited to have a returning guest, Mr. Oliver Reiche, over in Germany. And we first connected last year, one day to the year. And he was the first person I came across talking about the reverse repo madness that was underway. And it was a phenomenal discussion. So I wanted to do a follow-up. And here we are 1 year later. And things have gotten a lot worse since then, but not many people really touch on it and dive deep into it. So looking forward to connecting with you again, Oliver. But before I dive further, Oliver, welcome back. For those that may not know you, give us a smidget of your background and we'll jump into the rest of the discussion.
Yeah, thanks, Mike, for having me back to your show. It's a great pleasure to be there and, of course, talking to your audience. A quick background on myself. I'm the, let's say, founder of Ventorius, where I provide weekly new market analysis and research services to, let's say, people all around the world dealing with the stock markets and trying to get some ideas how to navigate the difficult markets in those crazy times we are currently in. I'm also providing with the services some trade ideas and investment ideas, so that not only that I'm trying to navigate them through the difficult markets with my analysis expertise, but also giving them some kind of action plays so that they can make money out of my ideas. That's one thing. And I'm also the founder of Blocktoria. It's a crypto research firm that I've been recently setting up. There we are providing different newsletter services and also research reports on different cryptocurrencies. Right now, a little bit shaky in the market, but that's what we are doing right now. But overall, thanks for having me back to your show.
Yes. So appreciate you for sharing that. Definitely looking forward to connecting. And for those that, as more people come in, definitely make sure you hit the subscribe button and they hit the thumbs up, show you some love for the channel. And so let me just, real quickly share with you. This is our interview from last year, and it was entitled Reverse Repo Anomaly Explained, a monetary tool driving stocks higher. So here we are a year removed from this particular time frame there, and you did a good job of breaking down and sharing with us a lot of visual aids and a lot of graphs. And I want to basically pick up from where we left off last year. And because things, it's double. I remember last year you were saying, like, if the reverse repo gets to, I think it was at that point, which is like 1 trillion or something like that. He was like, if it gets to 1.1, 1.2 by the end of the year, 1.9, and here we are, I think we're surpassed that. And so the world has moved on. Nothing's changed, or has it? So I'm looking forward to getting your thoughts on that. But if you don't mind, give us a little bit about the overnight reverse repo mechanisms and what it's for, how it's designed, and give us some details about it. Then we'll get into some graphs.
Well, let me break this down in an easy way so that everyone, is not so trickfoot about the technical terms behind the reverse repo thing. All you need to remember is that there are two ways to stimulate the economy or the financial system. One is through the repo program. That means you're pumping money into the market. And to suck the money or to take the money out of the markets, you apply the reverse repo. So that means all the money that you have pumped in prior, you are now taking out with the reverse repo program. But one important thing, and that is what I was not having on my mind last year, is that with reverse repo, when you are taking money out of the market, it is just for a day, but not permanently. And this is something I have to tell you later why this is an important factor.
Mm-hmm. Now, you're taking money out. So since then, since quantitative easing came into existence, I believe, is when the whole repurchasing agreements came about. And now, as of lately, the reverse repurchasing agreements has been more prevalent. And so it's taking money out. But then you say it's not permanent. So since March 2020, there's been, I think, in the U.S., from what we're being told, approximately 6 or so trillion, maybe 6 or 7 trillion, I think, or so, put out there in some form of emergency relief and aid or something like that. And so assuming that's what's been filtered or circulating through these reverse repo activities or what? Where's the currency? Where's all that currency coming from?
Yeah, the first thing is how you now described it is now there's a perfect way how to describe this whole situation. It's a complete chaos. Mm-hmm. Even let me phrase or quote one of the Fed members. This is Bostic. He stated in last month, so in May this year, he stated that probably or likely there is an excess of liquidity in the financial system of up to 2 trillion. He says even 1 trillion to 2 trillion. So this tells me that even the Fed members doesn't know how much excess liquidity is in the financial system. No one really knows, but we have an indication how much maybe of excess liquidity is in the system. And this is what I can share or show you based on the chart. It's based on the balance sheet of the Federal Reserve Bank.
Okay, so based upon the Federal Reserve balance sheet is kind of where we can get a ballpark figure as to how much currency might be out there. But then that's just what we're being told, because nobody's ever audited the Fed. You don't know what goes out the back door of any of the 12 branches. So this is what we're being told. But even it in of itself is more than needed, and it's problematic. Am I correct in saying that?
Absolutely. And, it all started with the pandemic and then with the, let's say, rescue programs or bailout programs to rescue the economy. It started in, I think, March 2020, when we had this mega crash in the stock markets and when everything turned really south for, let's say, a very short period of time. And then you saw this news coming out where they announced bailout packages from the government side with the stimulus checks. And then at the same time, you heard that the Federal Reserve initiated QE turbo. That means not only to put the rates to the zero level, but also to pump more money into the system, not officially by the reverse repo thing at that time, but it was based on asset purchases, what they did. And that was creating this massive bubble we are currently in, and they are trying to take control of, but they can't.
Okay, so let's as you were talking, I was looking through some of the figures that when we connected last time, you put some things on the screen. So I'll just briefly share with you just what I found. The reversal of the 10-year rate with the reverse repo. So at that time we were under 800 billion, and so lots changed since then. So if you want to kind of pick up where we left off last time, well under $1 trillion. Here we are now closer to 2, and walk us through what you've been able to put together.
Yeah. First of all, what you see is based on the chart that you just popped up on your window, is that back then, I think it was in March 2021, so last year in March, this whole reverse repo thing started to pop up in the news. So all of a sudden, you saw on Twitter and on other social media channels that reverse repo was all over in discussion. And people started to wonder, what is there going on? Where is this reverse repo coming from? And what has this to do with the current state of the markets? Back then, we were in a QE phase. Remember that. We are now, by the way, in a QT phase. That means quantitative tightening. So there's a total different game going on right now. Back then, a year ago, so the Federal Reserve was pushing the economy. They were pumping money into the financial system. I think what you even have seen is that we had craziness going on in the stock markets with meme stocks, with everyone going into the stock markets trying to make a quick buck. And that was the result of the Federal Reserve, who was pumping so much money into the markets, in the financial system, just to stimulate the economy. So, but they made one big mistake. They never stopped that until recently, until November last year, where they announced that they are now trying to fight inflation that was going out of control.
Right.
And now, of course, initiating the quantitative tightening. That means the complete reverse or the opposite of that of quantitative easing. That means quantitative tightening, you're hiring rates and or you do a rate hike. And then, of course, you're also sucking or taking money out of the market or system. But how you do this? And this is now how we need to connect all of that together. And for this, I would like to share my screen if there is a shot.
Before you do that, like just looking at that prior visual aid I just had from last year, 10-year rates was 1.75-ish. Yeah. Now we're above 3. So so we got to factor that in as well. So as they're pulling back, borrowing costs is going through the roof. So it's one of those things where something is happening behind the scenes, and I can't put my finger on it. So let us know if you put your finger on something.
Yeah, but you say, it was really like this. Last year we had not that much of idea what was behind the scene going on. Why suddenly the reverse repo is coming up, and why the excess, why no one really knows how much excess liquidity we have in the markets or in the financial system. So it was a crazy time last year. But now, a year later, I have an idea about all of that. It makes now totally sense what's going on in the reverse repo market, because they are trying to catch up on this excess liquidity that is existing on a daily basis. So they are operating that through, let's say, overnight lending system. So the banks that have too much liquidity on their balance sheet, they're sending this over to the Federal Reserve for the overnight session. And so the mechanism through that is that they don't need to show up on their balance sheets as regular banks. So we are talking about the Wall Street banks and maybe everything behind, like hedge funds. They don't need to report this excess of liquidity because they have outsourced that one for an overnight session to the Federal Reserve. And but the problem is it's coming back, and so they have to do the whole thing every day and night. and this is not really the solution for all of that.
So it's a repetitive cycle of slushing the funds around because it's in existence now. So I assume it is important because it keeps the banks solvent somewhat, because they've taken some major losses with, defaults and bankruptcies, and commercial lending I hear is through the roof. And of course, in Europe, you got the non-performing loans that are, I'm sure, just a bomb waiting to go off. And so it's like, okay, but all that currency is going back and forth. They're just greasing the wheel, keeping the wheels moving, greasing them over and over and over again. So my question, I assume it's much more complicated than I think, but why not just remove it? Like, let some things expire, because I'm assuming all that is some type of collateral debt obligations. Let some things roll off bit by bit. But then again, the system requires continuous injection to stay alive. So,
and so the simple answer to that is, if they would permanently remove the excess liquidity with one hit, so removing the reverse repo, and then, let's say, shrinking the whole excess liquidity about 2 to 3 trillion of dollars, then it would create a crater in the stock markets and in the entire economy in the US. That's the whole thing. That's why they need to do this reverse repo. If they would not use this reverse repo tool, by the way, the Fed is always talking about tools they are applying, and one of those tools is reverse repo. If they would not apply that, we would already have hyperinflation tendencies. That's my assumption. Because with reverse repo, you keep the high inflation that we already have under control, that it's not even going, further up.
So if the reverse repo activity of slushing funds overnight continuously stopped, the current currency is in existence would then reach the markets, and then really, you say hyperinflation, like that's how we could get to hyperinflation type of thing.
Yes. Yeah, of course, because then suddenly this how much ever, I mean, now this is the latest number of reverse repo today. I think it was 2.2 trillion. So imagine you have suddenly this $2.2 trillion more on the balance sheet, and it's not going overnight to the Federal Reserve. That means it's finding its way to the wallets of the people. It has to find, or the way into the system, into the consumer system.
Now, a part of expansion of the monetary base, because I think, let me know, but what they're going back and forth recycling would be considered reserves when they're in the Federal Reserve possession, and just just deposits, or not, because it's claim on deposit. It's claims on deposits, but it's not really something that because they have to lend that out in order to get currency circulating in the economy. So if it parked in the Feds, if it was parked in commercial banks, it would equate to savings, and they got to pay interest on that. But we're already 0.001% savings, so it's like it's So it's confusing as hell. But
I wouldn't make it too complicated. I wouldn't really keep it simple. Because the most people I'm talking to about reverse repo, and if I'm explaining this in detail, they are losing track. And then somehow, then that's it. Just all the people, even when I'm talking to my team of analysts in internal team meetings, I always try to tell them, look, all you have to know is that Reverse repo means you take money out of the system, but this is not permanently excess liquidity. And with repo, what we have seen in 2019, in September 2019, you're pumping money into the system. That has stopped, because then officially they initiated with the March 2020 crash, the asset purchase program. You remember that? So
Right.
that was doing turbo, and then they replaced that with the repo thing.
Yeah. So I remember you saying, I remember, September 2019, is when, the easing began. It wasn't easing then until March hit. So they was already having liquidity problems back then. Correct. And so the question is, how does this, in your opinion, how does this end? Like, you're providing all this liquidity for some type of event because it can't go on in perpetuity. So it has to come in at some point.
Yeah, I mean, you see the issues we have right now in the markets and in the economy. I mean, now people are also affected. Just go to the gas station now, especially in the US, the average gas price is, I think, $6, $5 to $6. I mean, this is not normal. And then you have also to pay higher rents suddenly. I think the rents are up at least by 20% from the year ago, at least, I would even say. So the effect is now coming through. Yeah, they can't keep this more up. And at some point, and the banks, by the way, they have to transfer this huge amount of trillions every day, every day and night. At some point, there will be an excess in, let's say, in the system itself. So they can't deal more with this huge amount. I mean, look, I will show you later a chart where we'll be showing as a CPI, the US CPI, in, let's say, comparison to the reverse repo. And you will see very clear that with the reverse repo amount, they are trying to catch up on the CPI so that it's not breaking out that much. And the same thing they are applying with other, let's say, kind of 10-year rates, for example. So the 10-year rates, I made a phrase in my Twitter account when I showed the 10-year rates in comparison to reverse repo. So higher the reverse repo a day keeps the doctor away, or keeps the 10-year rates lower a day. And it's a trick they are applying just to, to keep the inflation somehow under control. Even though we are now at 8.6% on officially the inflation rate in the US, without reverse repo, it would be much higher right now. It would be much higher.
Okay, so looking forward to see it on the chart. So 8.6 is what we're being told. That's according to their measurements that they give us. Yeah. But then we got the alternative stuff saying, double that. That's probably more realistic, especially what you feel on the street. So I'm thinking, like, if they were to stop reverse repo and that is their way of keeping things down, then, as you say, like, stuff can really hit the fan if they did not have that control mechanism to somewhat keep inflation from shooting through the roof.
Look, they have one issue. This is the biggest issue. You're dealing, they are saying basically the US stock market is not that much important and it's not reflecting the economy, but it's reflecting the economy based on Donald Trump and other players in the market. Right. So if you would now, let's forget now reverse repo. Let's think about the balance sheet of the Federal Reserve right now. It's at $9 trillion approximately. So if they would remove now $2 trillion or $3 trillion of this reverse repo that we have on the same amount, this would bring the stock market down and the economy, because suddenly you have the situation when you take 2.2 trillion or up to 3 trillion of the balance sheet, when you reduce the liquidity, you have less loans to give to the people. There is less consumer spending going on. The budget deficit, how they would finance the budget deficit of the US government. I mean, all those guys, living from, let's say, your taxpayers' money. But even the taxpayers' money is not enough in the US because they are, creating a huge amount of budget deficits every single year. I think up to 2.8 trillion was it in 2021. So this is something the Federal Reserve has to finance. And they can only do this by expanding the balance sheet. And when they have to reduce all of that, that means the Federal Reserve cannot jump more in and to provide this money. That's the whole thing. And that's why they need the Fed somehow to stay on that level of the balance sheet, 9 trillion, and apply this reverse repo thing.
Now, speaking of which, I had a conversation earlier with one of my guys, Manico64, and we were talking, or didn't get a chance to talk about, but I'll share this with you. Even though the Fed said they're tightening, they're going to start reversing, but according to just like within the last month, whatever was sold off or rolled off, they happened to purchase something within that last 30-day window. I think it's to the tune of 20 or so billion. So have they really stopped, A, and B, can they really afford to tighten as far as letting things roll off, or however they try to down their balance sheet, while you just said that, if it comes down, that's going to be a problem in of itself with the reverse repo side. So it's like they're damned if they do, damned if they don't, but something has to give, or it already has.
But you name it. I mean, that's everyone is observing the same issue right now. I have also seen that. When they started officially to say, okay, we are doing now the quantitative tightening program, and they said that, of course, includes a balance sheet reduction. Have you seen the balance sheet? It was not even reducing a single bit. I mean, every time it was dipping, by the way, the stock market was also going down. And when the balance sheet is going up, then the stock market somehow is stabilizing or consolidating, and then it's also going up the next day, maybe. Today, it would be very interesting to see how the stock market is going to the end, and to see if maybe, the balance sheet of the Federal Reserve is increasing again a little bit with the latest data.
Interesting. Now, so let's get into some charts, man. Show us some of your recent findings, because we're a year removed. We're under a trillion then. Now we're well above 1, heading to 2. And I remember, following your Twitter, you were saying, by the end of the last year, it's going to be, I think, almost 1 or something like that, or whatever money you put out, not much put out there. But we surpassed that. So, can reverse repo double now, go to 4? If the way this thing is going. And is it how does this tie into that landing part? Like, how are you gonna land, soft landing, hard landing, if you're still compounding on to the overnight reverse repo stuff? So anyway,
it is fantastic, because they have really, not only that we have more reverse repo amount now in this, to deal with, 2.2 trillion. A year ago, it was just 1 trillion, and we were thinking about maybe 1.5 trillion should be the end. Why is this so? That reverse repo has to, be much more than it is, than it was when that we were forecasting, because they were expanding the balance sheet. This is the same way. They were not stopping last year to reduce this balance sheet with quantitative easing. They were basically propping up their balance sheet as well. So they were applying asset purchase programs and so on and so forth to prop up their balance sheet. Do you want me to share my screen, or?
Yeah, feel free. I was actually looking at some of the graphs from last year that you were showing. So just to show how things have changed significantly since then. Feel free to share your screen. And and also for those that are tuning in, definitely, if you guys have questions, thoughts, ideas, put it out there in the chat. We'll get to it when we open up the Q&A part. A couple more seconds of this, just trying to get the deep dive, and we can go from there. So got you on screen here.
Yeah, perfect. So what you see right now here is, and by the way, this is officially, everyone can look up. It's from the St. Louis Federal Reserve source. So every one of you can look this up, so that not it's manipulated or whatever. What you see here is the one line represents the total balance sheet of the Federal Reserve. So here you see that from 2017, it's going down. That was basically where Powell said that we are applying quantitative tightening. That was in 2017, and they tried, I noted that here down, they tried to reduce it by up to 1 trillion, but then they capitulated. And remember, when they started to capitulate with the reduction of the balance sheet, it was in September 2019. That was the day where repo was kicking in.
Right.
So here it was going down. And do you see this here? This is the red line represents the S&P 500, so the stock market. And do you see how the S&P 500 was starting to struggle when they started to reduce the balance sheet? And then we had even 2 mini crashes in between here. And then in September 2019, they made a complete reverse, so a capitulation of that. They initiated again quantitative easing. Officially, they said that time, we are not doing QE. You remember that, maybe the phrasing they used back then. They were officially saying, no, it's not QE, but it was QE. And And so when they started to initiate QE again, then you see that the stock market was going up until the point where the pandemic was hitting in. And then we saw this huge crash. And then we noticed a complete change of the, let's say, the narrative. So suddenly it's not more, we are doing something for the economy, but it's not QE. Suddenly it was QE, but not only QE with, let's say, repo. They replaced repo with asset purchase programs that increased all of a sudden the balance sheet of the Fed. And that's why here you see this arrow from approximately $4 trillion or $4.4 trillion to up to this date, 9 trillion. Yeah, 9 trillion. So they doubled the amount in the balance sheet. And of course, this has an effect on the economy. That has an impact on the prices that we are seeing now getting out of control with surging inflation. I mean, it's so obvious that this year, this would have an impact. And I remember there was another analyst back then, Peter Schiff, and he was basically saying back then here that this year will create an inflation we have never seen in our lifetime. It's so crystal clear. And so what happens ever since then? So since March 2020, they started to initiate the largest QE program ever in history. So the largest QE program. It was a bazooka. So basically they were pumping so much money into the system. And here you see this from 7 trillion in July 2020 to 9 trillion. So in just 1.5 years, they pumped it up by another 2 trillion. And then the first issues that kicked, and of course, you see how much money they pumped into the system, how much money goes into stock markets. Here you see that the stock market was making new all-time highs almost on a daily basis in 2021 last year, with all those meme stocks going crazy, and everyone was making money. Even the crypto scene was going.
We had. I think it was 2 stimuluses. It was one in January, the family something or another, then the Patriot in March or April, and then last March was the last round of stimulus that was given supposedly as cover-up money for whatever. But anyway,
exactly. There was free money for everyone almost, and you have seen this because with their stimulus check, most of the young guys, I mean, they couldn't go to work because they were sitting at home. So suddenly they had the stimulus check. Maybe they got even more than they would earn when they go for work anywhere else. And then they discovered the trading system for themselves. They said, oh, there's a broker app like Robinhood or so. I can use that to make money on the short term. So I'm sitting home and make money. Don't need to work more for, let's say, job, going for security or as a dishwasher or anywhere else. Yeah, doing a guard. You see all this craziness was going on last year. And all of that was the consequence of the Federal Reserve that was pumping so much money, free money into the markets or in the financial system that people really started to shift their employment and, of course, the way they were doing business. So, but then you see here, end of 2021, you see suddenly a shift in the markets. Ever since then, we are struggling, or we have been struggling a lot. You see that, right?
Yeah.
And that was where the Fed was announcing, okay, people, let me tell this in other words, people, okay, we had a lot of party, but now the party has to come to an end because now we need to stop this bazooka game. We don't have that much of free money. So let's stop this party because now we are also getting to the first notes or reports that the prices are surging, for daily food and so
transitory.
That was all going in. Exactly.
That's when they changed the transitory. That's when transitory was starting to be questioned by mainstream, and all of a sudden,
yeah, exactly. You name it. I mean, it all started, I think, around March in 2021, where not only, I mean, we have seen here, there's a massive increase in liquidity just in a couple of months. And that was going into the financial system. And then the effect of that, I think all of that started to pick up in March or in April last year. And then we saw that CPI numbers, slowly picking up. It was just a slow start at the very beginning, but people already understood when they went to the grocery that something is going on. That is the same stuff that they bought a year ago is suddenly somehow 10% higher or 20% higher. Right. Let me flip to the next slide.
So before you
Yeah.
go to the next one, so based upon that the trajectory of the S&P right there, it's turned over. So that to me is a clear indication the Federal Reserve has already picked what they're going to be willing to sacrifice as of now.
Yes.
And so they're going to let that thing correct while trying to use the narrative of we got to fight inflation, which is that repetitive wheel of reverse repo over activity, keeping the CPI numbers, their own numbers at bay. So they're going to continue to trend together is what I'm getting from this. But go ahead.
Yes, and I also noted that here. I mean, this is something I was putting here up on the slide. So this is one thing, I wanted to remember is that they were struggling when they reduced the balance sheet up to 1 trillion, and then they were reversing the course because they saw that the economy was somehow not liking this, what they were doing.
Right.
Today, or in this week, Powell was testified, and he was giving one statement, and that was I was bringing here up. He said endpoint for balance sheet would be roughly 2.5 to 3 trillion, smaller than it is right now. So he is basically saying that, okay, we are aiming to reduce this balance sheet that is now at $9 trillion by up to 3 trillion. So that means 6 trillion if they are trying to accomplish that. So they are trying to bring it down to 6 trillion. So can you imagine what this has an effect on the stock market and the economy? I mean,
it's already rolled over. So literally, that will be the crash of all crashes that we were warned about.
Yeah, I mean, it's so. I mean, think about that. Here, this means party, and no more money means party is ending. So that means everyone is just escaping the party. Yeah, so the last one is getting hit, and you don't want to be the last guy on the party. So that's the one thing. Let me jump to the next one. Here, for example, a very interesting chart that I have created with the help of the Federal Reserve, St. Louis. So the blue line represents the CPI, okay? Change on a year-on-year basis. And here you see that the CPI was basically picking up last year approximately around February, March. It was the same time when reverse repo, this is the red line here, was kicking in. All of a sudden, you remember that was the time when we both got connected. And you asked me, hey, what's going on over here? I mean, what is this here? What is this here? So, and this is why I overlaid this with the CPI, because they had to apply reverse repo to catch up with the high rising inflation. Here you see that. Yeah, it's basically correlating to that perfectly. And now, this is now something I can give you for free for your audience. Here you see, this is the CPI from May. And we are now ending June very soon, in a week or so. So that means, look where the reverse repo is right now. I mean, that was the reverse repo from yesterday, by the way, with the last. So 2.2 trillion. That means the next CPI number that we are getting for June, so for this month, I will be expecting to be here somewhere. I mean, much higher, I think above 9%, 9.5%.
Wow.
I expect the CPI for June. So that means, because you would not have such a high reverse repo going that forward here.
Now, just looking at that graph to the far right, right before this most recent spike, which probably puts us in, last 30 days, 30 to 40 days, it was trending sideways for a little bit, like up and down, sideways. And then it shot up as if like right then and there, something else happened. Cause even the slope is not straight up. It was starting to turn as if it was starting to be more adjusted. Then it shot up right where you have it at now. So I wonder what was that event? What was it? Where what was said or did around the world? Or that's interesting.
Yeah. I mean, one effect could be the Ukraine crisis. Ukraine crisis started to get out of control in March this year, where suddenly Russia invaded Ukraine, and then you had all those, let's say, extra spendings going on, especially for the U.S. government with their military aids and maybe other financial aids they have been contributing to Ukraine. Yeah. But also, I will show you that later. It's not only an effect in the U.S., but also you will see that in the European countries. Within the Eurozone, you have the same effect. It all started to get out of control with March, April this year. Yeah, and I think of course, there are more factors coming in. Not only the Ukraine crisis, but it's also the supply chain issues, the never-ending supply chain issues. Then we have the huge credit card debts. Then we have ongoing pandemic issues. The monkeypox was the latest version of that. And Ukraine crisis, and then you have a kind of a mix of a very toxic cocktail right now going on, and they are trying, of course, to keep this under control, but in my opinion, they already lost control. Okay, let me show you one more slide. That's something I am posting from time to time on Twitter. So basically, it's the same. Here you see the reverse repo in red in comparison to the 10-year rates. So the 10-year rates basically is also another indicator for the economist to see if there's, let's say, a high inflation coming over the next 10 years. And right now we are near 3% or even above 3%. So that's really a bad thing. I mean,
so right there, back where we first connected is where the graph that I showed where, and so so I wonder what was that? So like that divergence, the flipping, and then the divergence, and then now it's meeting again. So give me the rundown on how that flipped, and then now it's catching up again, and it's parallel.
So I can't tell you the technique behind, but what I figured out when I started to observe that and also to document that, you can look this up to my Twitter profile. I observed that every time there was a higher reverse repo, they pushed somehow, or they were able to push down the 10-year rates. That's what I was figuring out. And I was also bringing the two data, the two time series in correlation together. And I got as a result, for example, for last year, that there was a negative correlation going on of up to 40%. That means that every time the reverse repo is going higher, they're pushing down or bringing down the 10-year rates.
Right.
And that's what you see here. So first, the 10-year rates was going up and up and up, and suddenly you see here the reverse repo, showing up, and suddenly the 10-year rates are somehow moving sideways, and then the higher the reverse repo, the lower somehow, or they could control the 10-year rates. Right. And at some point, here they were stopping this somehow, and you see suddenly the 10-year rates was spiking. And now they are moving up, or let's say here they started maybe to make a shift, or they were having discussions within the Fed. Maybe we should now get rid of reverse repo in March. But then there was this Ukraine crisis going on. Don't forget that. And then they maybe said, okay, now we have to apply the reverse repo more, and even much more. Yeah, maybe there were really plans. Look, I have to give the Fed a little bit credit. Really, maybe they had plans here in March or in February to bring down the reverse repo and maybe to reduce the balance sheet. Yeah. But then you had this Ukraine crisis going on, and suddenly you have to shift against the whole course that you were initially preparing to do. Right. One more thing is, of course, to make you understand what's going on. Why we have this crazy inflation getting out of control is just look at the public debt that we have in the US, more than 30 trillion. This is the last amount that I have. Soon it will be updated. Remember, next week we will be ending Q2, and then we will get the fresh new numbers. And I bet it will be much higher than 30 trillion. And here you see this. This is 2020. Look, here from 2010 to 2020, within 10 years, it was increasing, let's say, a lot from, let's say, 8 trillion to 20 trillion. That was here under Obama and Trump. And then suddenly we had this vertical move to the upside with 2020 and the pandemic issue going on. And it's, of course, creating issues. And this is, by the way, another reason why, when we have so much debts out there, why we can't raise short-term rates that much of high to catch up with the rising inflation. Because the more we increase the short-term rates, the higher, let's say, the regular consumers like you and me have to pay a higher interest rate for our loans that we have on our mortgages or anywhere else, or credit card debts even.
Yeah, and then like the reverse, the yield curve inversion. If the shorter goes up higher, and that signals recession, and so we've been flirting with that last couple of months steadily. So it's like, okay, we're not in a recession yet. Okay, sure. Anyway.
Yeah, so you maybe heard about that. All of that, of course, when you have to reduce the balance sheet of the US, that's the biggest fear is that not that they are fighting inflation, but this will be creating a recession. So how do we get into a recession? There are two basically indicators that we understand we are now in a recession. Maybe when you read the news right now, you hear that we are already in a recession. Some even say, no, we are not yet in a recession, but we are about to enter a recession. So how do we understand if we are already in a recession or not? And I want to give some credit to Harvey Campbell. This is the basically the inventor of the yield curve thing. So he basically discovered that when you take a look at the yield curves, so the 10-year, so the spread between the 10-year rates and other, let's say, shorter term rates, for example, 3 months, then, and when they do inverse at some point, then you have an understanding, or let's say a more meaningful number if we are already in a recession or not. So, and he basically says two things from his point of view, based on the yield curves, two things you have to understand. So one thing is, he said that otherwise, or let's say regardless of the media, who is always talking about the 10-year and the 2-year, he says so the most important spread is between the 10-year rate and the 3 months. So, and when they do invert, this is one indication that we are now in a recession. And when you look at the chart, and this is, by the way, updated with the most recent numbers, still not inverted. Here's still the spread. So this is the 10-year rate, and this is the short-term rate, the 3 months. So it's basically the Fed funds rate. So you remember there every week or every month there is a Fed meeting going on, and then they're discussing about the measurements. And then now they have been raising rates very quick, and you see that here within just 2 months they raised it basically from 0 to almost 2% to try to catch up with the inflation here going out of control. And they have to raise it even much more. And Paul already indicated that in this week in front of the testimony. Of course, when you see, based on the historical chart movement here, here is, by the way, the S&P 500, you see every time when there was an inversion of the 10-year and the 3 month, that's why you see here the circle, we get a crash in the markets, a real crash. I'm not talking even about a slight crash, we're getting a real crash. So we now look at this chart here. People already say that we got a crash, or we got a correction. So now you tell me, when we get this inversion over here, what will happen then? What will happen then? So that means we might be due for a crash that we are even not imagining right now how much further down it can go.
Right.
That's one of the things.
So watch this. Based upon probability and just looking out ahead, if those were to meet, assuming it's going to be where, is that where the Fed gets another hike or two, or barring the or something breaking before then, to where they would meet and all hell would break loose? In the meantime, the S&P already been trending downward. So it's like, if based upon what you're seeing now with all the numbers, with all the reverse activity, how much longer before, if everything stayed normal minus any unforeseen events, would we be able to see some type of inversion and correction, severe correction?
Yeah, I mean, they already indicated that with the next Fed meeting, we have this in July, in middle of July, so 3 weeks out. They already announced that they will do another 50 to 75 basis point increase. That means maybe up to 2.5%. So you can then make your math. I mean, if this is going to 2.5%, and maybe the 10-year rates are coming down, then we have the inversion. And here comes the thing, the big thing. There are now some analysts saying that once we are coming to the point that we are getting to an inversion of the yield curve, that could maybe bring the Fed to pivot the strategy. Yeah, so that they maybe say, okay, not only that we got an inversion of the yield curve right now, but also maybe we are getting a second negative GDP number. So remember, we had a negative GDP for Q1, and then we get a second one for Q2, and that would already also indicate that we are in a recession. Yeah, if you get 2 times a negative GDP, that means we are technically in a recession. And so then you would have all those indicators confirming that we are really in a recession. And that is usually the turning point of the Fed to say, okay, we need to do something. We need to take action right now, not to crash this economy. So it will be very interesting in July what is going to happen, but we will get something very exciting. That's what I believe. And by the way, I'm looking to the side because I see you're right now here. Not that you're wondering.
Yeah.
I'm looking
Oh man, so so based upon what you just laid out, that's a double whammy, like a double, possible triple confirmation that we're in a recession. And like to me, that spells something a lot more catastrophic than just your typical recession. Like people, I mean, I thought the word depression just because it's not just an isolated event here in the U.S. Like Europe and so every nation is facing something similar because of the debt system and the amount of stimulus trying to find a home and inflation. And so,
and you know what? Look, if they are trying to pivot, I mean, let me show you just another quick slide. So Campbell not only said that the 10-year and 3 months have to invert, but also, sometimes you heard in the media or in the news that the 5 to 2 years is inverted or the 10 to 2 years is inverted. And yes, it happened. But Mr. Campbell said that if it's only meaningful if it's persistent for at least 3 months. So if it's staying for 3 months inverted, then this has a meaningful meaning. Then it's really meaningful. But if it's just a short-term lift inversion, then it's not meaningful. So that's something you also have to remind. So most important is what you have to remember as your viewers is that they have to take a look at the 3 months and 10-year rate. One more thing. This knows something about this is here a chart I wanted to bring up just to make you understand in your audience where we are currently in the economy. And based on the current conditions that we have with quantitative tightening, that means not only raising rates, but also they are planning to reduce the balance sheet. So if you have seen the chart, let me pull this up one more time here. You see that here we went up, and now it started to shift. So I believe we are somehow here right now. Because you hear right now the voices and in the news like JP Morgan, Jamie Dimon, who said, I believe we are in a recession already, or some even say we are not yet in a recession, but we are close to recession. So we are somehow here. And usually when we are getting to that point over here, so that means the yield curve's inverted, we have 2 negative GDP and numbers, in a row. And then, of course, we have a stock market crash. Then this is usually the time where the Fed will pivot their turn. And here, that's what I'm saying.
Yes. So that recessionary drop is still above the previous one, to where in the real world, I think that boy going to probably be off the page. Like that's how bad it could get given the global macro picture of things. But
and this will even be much bigger than most of us we grew up after let's say the Second World War, but before the Second World War we had in 1929 the big stock market crash going on. I think the same way that we had in March 2020, but there was a difference. In March 2020 we initiated, or the Federal Reserve initiated, one of a quantitative easing program, that was propping up the stock market again and the whole economy. In 1929, they were not doing this. I think they were doing only light QE. I need to look into that. But what you see is when you follow the stock chart from 1929 is that we went into, it first started with a recession, and then we were entering a depression. And that was taking much longer. And to be honest, with all the circumstances that we currently have, pandemic, Ukraine crisis, a Fed or a central banks that have to tighten because they have to somehow fight inflation. So they have to reduce the balance sheet and to raise the rates. And then with anything else, mortgage issues, real estate market is about to blow up.
Yeah.
It will be, put it all together. We have now the craziest toxic cocktail we have ever maybe witnessed in, over the last 100 years. And that is now coming is about to blow up now.
Wow. The craziest cocktail. So we did a good job of diving deep and showing the stats, man. Stats and don't lie, man. The numbers don't lie. We're 50 minutes or so. So I want to see if there's any questions from the audience. And then you're in Germany, so you're experiencing something severe as well, all-time high and things. And, you guys have an interesting history with the Weimar situation 80-something years ago. So, what's the sentiment as far as how the German people are feeling? Are they like gold bugs, or are they hedging against the euro, or what's going on in the streets as far as overall, feel?
To be honest, if I'm going on the street right now and I see the people, nothing has changed. To be honest, nothing has changed. I see even more, let's say, guys driving a Porsche around, and people having fun, going to parties and spending at groceries like there was no other day tomorrow. People are having a regular life right now. And the unemployment rate, by the way, is at 5%. It's pretty low. It's below 10% of the typical target to see or to understand if there is some issues in the economy or not. So it's at 5%. By the way, in the US, it's 3.6% right now, officially. But maybe it's getting up again with all the layoffs and freezing of hiring that is going on right now. But there's still, let's say, a good life here to make. But we have now this Ukraine crisis going on. And then you have also the issue with rising inflation. So the people, even though they are still, spending regular, let's say, for daily life of things and having fun, they are feeling that something is going on with the prices and that they have less money or purchase power. They have less money in their pockets, in their wallets. So the purchase power is, of course, declining with rising prices, but the wage is still at the same level. Somehow we have now another issue, and this is maybe something where most Germans especially are very afraid of. Because of the Ukraine problem, they try to disconnect Germany from, let's say, being the energy demander from Russia. So the gas supply should be stopped and cut and replaced by another one. So they cut now the whole gas supply, or they're trying to cut it.
Right.
And we are trying to find another player. Maybe it will be Qatar. It should be anyone, but not Russia. And this will, of course, have an impact on the energy prices in this winter to come, because we have in Germany seasons, and we have also cold seasons, especially starting with autumn. And that's usually the time where people are starting to consume a lot of energy, especially gas and electricity, and to heat up their heater. And that, of course, will have an impact on rising prices and maybe oil, gas, everything at the same time. And maybe the big issues will start to come through. That's my belief.
Wow.
Right now, nothing to see.
Right. And so I actually saw an article recently saying that, Germany's looking to fire up their coal plants again, just to prepare for what might be a cold winter. So the EU situation is going to be interesting, man. So before we dial back, does anybody out there want to ask some questions? Feel free to ask. Just highlight everything in a dollar. It'll stand out and I'll ask. But the euro debt crisis, bond yields are spiking, pig nations are failing. Yes. Could there be an event that occurs inside of the EU that is the primary domino that spills over and disrupt the Fed's plan and causes a meltdown, contagion type of event, or what's the state of the EU? Because they're tightening while they can't afford to tighten because you got all those countries with problems. I'm sorry, go ahead.
Yeah. So you just stated. So in the EU, we have this issue that we have some economies or some states that are not so productive, like Germany is. And they are, of course, when they are not so productive, they have to make more debts. So they have to make more deficits for the government to catch up on this, let's say, or to offset this, let's say, competitive advantage that we have as Germans. And this is, of course, bubbling up their debts for every single nation. Right. And I wanted to show you this. I created one chart. You can see right now that inflation is not only in Germany, but also in the Eurozone, all across the European or the Eurozone members picking up, especially for,
Yeah, you share your screen if you want, because if you want to show that chart, you got to put it back on that.
Let me share my screen very quick. One moment.
And let me see. I don't see any questions outright, so we might have to figure something out. But anyway, no, a lot of information was definitely shared. Man, this is
yeah. And this comes to the point that I was telling you up front this interview. So when you see my screen, let me know.
Yeah, no, I see your screen. There's nothing on there. There we go. Oops.
Okay. So what you see right now here is that unlike the Federal Reserve, who is really doing quantitative tightening based on rate hikes, the European Central Bank hasn't even started with that.
Yeah.
Since 2014, where you see this red circle, they are even going below the zero rate. I mean, they are negative. They have negative interest rates. It would be, of course, a dream for Donald Trump and the US to have negative interest rates. But that's what we are in right now. And of course, this has created a massive distortion in the European sector. So you see that countries who shouldn't spend that much, they have spent tons of money because they got this extra free money and they have spent this into the real estate sector or for the government. So basically to hire people from the street and to engage them or to give them work for the government or with the government. And so you see that they have to shift now the course, so to increase the rates. And they already indicated that they want to increase rates. But at the same time, and that happened last week, they announced that they do now quantitative easing again for the asset purchases. So they are controversial and they're saying, so they say basically, okay, yes, we want to fight inflation. We are raising rates now. We want to go above zero, at least, not more negative. But hey, we have so many issues right now with the Ukraine crisis and in the Eurozone. We have to buy the asset. I mean, we have to keep buying the asset purchases again, or we initiate this asset purchase program. So it's a complete ridiculous change what's going on. And it, of course, it's not quantitative tightening what they are doing. It's quantitative easing in a different form. It's quantitative easing. And here you see the consequences out of that. This is now a chart that I put together, and here you see European, and I filtered that for all members in the Eurozone. And funnily, what I discovered is that the top players here, I mean, with the highest inflation based on May results, are Estonia, Lithuania, Latvia, Slovakia, and then comes Greece. But I was wondering, where are these countries located? And then I was bringing up this map over here, and you see that Estonia, Latvia, Lithuania, they are all those countries that are having Russia almost as their neighbor. And then you see also here Slovakia, not Russia directly as a neighbor, but it's, here in between is, I think, Belarus, and then comes Russia, or Poland. And so we know that, and then you see here's a change on a monthly base, how much has changed. And you see that Latvia was really picking up. Finland as well. By the way, Finland, I was not highlighting here, Finland also increased their spending, and I think it has all to do with the Ukraine crisis that is going on. So that they are propping up their military spendings right now. That's what I believe. But yeah.
Wow.
Last statement I wanted to say and to bring to your audience. And I want to say is, if you are invested in the stock market, and let's forget now about maybe we get a crash and we are entering a recession, or we are ending into a hyperinflation. There are two ways you can maybe navigate through a difficult time. And this is one thing: if you believe there's a recession coming, go with treasury bonds. And if you believe there's an inflation coming, go with commodities. And so the best of that would be just to diversify your portfolio based on these two. Yeah. That's somehow my bonus. And I can stop sharing my screen.
Good deal. Good deal. So we do have a question. I want to, let me find it. Let me see. I saw it, and then we'll get ready to dial back. It was from Mr. Evola. Let me find it real quick. Let me see. Where'd it go? Where'd it go? Give me 1 second here. I saw it, and I should have brought it up then or set it aside. I might have lost it. I forgot what it was, but it was an interesting question. I think the question was, do you see hyperinflation or deflation first? I think that's what it said.
Yes. Look, we are now in a stagflationary environment. That means there is a slow growth going on, slow economic growth, but we have at the same time inflation. So that's why it's called stagflation. And what usually happens based on historics, before a hyperinflation comes to fruition, is a deflationary environment. That's what I believe is coming first. That's what we are seeing right now, because they are taking money out of the system. And of course, people have less money to spend. They have issues to pay. And then the prices of commodities and even of regular, let's say, food, maybe energy prices too, they have to come down to meet the demand or the supplier. So supplier demand.
So deflationary correction first, and then response to that, monetary prices might be cranked up like never before. If governments uniformly decide to pivot together to save things, I also believe that there's a probability that a lot of this is factored into that Great Reset agenda, and of course, this is along that pathway to rebooting the system. So what better way to let it crash? And then they'll come out with, we need to pass CBDCs to make sure we provide direct stimulus to the people. And then that pathway creates a whole nother way of stimulating through quantitative easing, however they structure those, debt buying, purchases, whatever. So the Federal Reserve's balance sheet can continue on, but just in a new form of currency creation and bond purchases through, anyway.
I have another theory. I mean, you can solve all of these issues with a debt cut. I mean, with a haircut of debts. That's how you can solve the issues with inflation. And then, of course,
who takes the cut? Who everyone takes the cut, because the cut isn't a currency.
the investors, they were, giving the money, and of course the regular people. But of course, everyone will be affected with a haircut. And by the way, it happened back then in the Eurozone as well. I mean, in 2010, 2011, with Greece. They also applied a haircut over there. And then they started to stimulate the economy again with QE. And that's probably something we should have as a wild card right now, open. So that the Fed maybe not only change the course in July when they see that everything is just falling apart, but also maybe that they apply a haircut. And then they say, okay, that's it. We have to do this to keep inflation under control. And now we are boosting at the same time the economy again with a new QE program. And that's, of course, the big banks and for commodities.
Yeah. Oh, man. So anywhere it go, it's going to be very uncomfortable no matter what. But Oliver, I appreciate you for joining us. For those that want to find out more, here's your Twitter account, and they can connect with you there, as well as, be able to get to your Substack as well. Do a good job of, keeping people up to date and, sharing tips and tricks on how to benefit off this transition. So I encourage people to go check them out. And also, I'll put it beneath this video here so people can find out more. But it's been 1 year since we last connected, and the QE doubled. So, maybe we'll connect again sooner. it'll probably be, half of that at that point, or who knows what'll happen. But appreciate you for your analysis and everything in between. And as always, everybody, thanks for taking time with me on Friday. And good luck. Have a great weekend. Be blessed, be safe, and see you guys later. Peace.
Thank you very much, Mike. Good to be back.